Good evening, everyone. I hope you're doing well. Today is Monday, the 12th of January. So today we are going to look at how to prepare an income statement, or what we call a statement of comprehensive incomes. So an income statement is one of the financial statements that are prepared at the end of the year, or what we call the final accounts that are prepared to summarize the year. So after preparing the cash books, the ledgers, trial balance, so at the end of the year, you're supposed to come up with what they call final accounts, and an income statement is one of them. We also have a balance sheet, of which the income statement determines the profitability of the business, and the balance sheet determines the financial position of the business. So specifically today, we are going to look at an income statement, or a statement of comprehensive incomes. So an income statement is made up of two statements, where we have a trading account and a profit and loss account. So when you look at the trading account, it stops at finding the gross profit. Then in order to find the net profit, you're supposed to add on what they call profit and loss accounts. When you combine those two vertically, you come up with what they call an income statement. So basically, that's a brief introduction about an income statement, or a statement of comprehensive incomes prepared to determine either the net profit or net loss of a business. So I've talked about this. It's prepared at the end of the year to determine the profitability, where you can either have a net loss or a net profit. So after incurring all the expenses and receiving all the incomes at the end of the year, we expect you to come up with, it is an accountant, we expect the business expects the accountant to come up with financial statements to determine either or see if the business has made a loss or has made a profit. So they use an income statement. And for most of the companies, these statements are always supposed to be made public, so that the whole public can see these statements and see how the business is progressing. By law, it is a requirement to always publish their financial statements at the end of the year. So we have components of an income statement. One is opening stock, or what they call opening inventory, the stock that you start with at the beginning of a trading period. You have the purchases, the goods that you buy or resell. We have purchases returns, or returns outwards. These are things that were once bought by the business, then returned from suppliers. We have goods available for sale, whereby we look at all the goods that you have at the moment for sale. That's why we add the opening stock plus the net purchasing, buying the goods available for sale, the things you have currently that you're going to sell. Then we have direct expenses. These are expenses that directly affect the purchases of the business. So where we have wages, and we also have carried in purchases. Carried in purchases or carried in ones. Then we have net purchases. So net purchases is the exact value of purchases that you have at the moment. So for this one, you're supposed to add the purchases plus all the direct, because these direct expenses are considered as part of the purchases, because they directly affect the cost of the purchases, or they directly impact on the purchases. So when you subtract the returns inwards from the value of total purchases, or which total purchases is purchases plus the direct expenses, you get what they call the net purchases. Cost of sales is also another component. Now this is like the cost of the goods that you're going to sell. The cost, at how much, what was the exact cost of these goods that you want to sell to people. so that we can determine your gross profit. So the formula is very simple. Is opening stock plus net purchases minus closing stock. Then we have sales. These are things that have been sold by the business throughout the year. Then we have sales returns. These were goods that were once bought by the customers of the business, but later on returned by the customers. We have gross profit. Sorry, before gross profit, we have net sales. So net sales, these are the exact value of goods that were sold by the business, whereby we get the sales minus sales returns. So you get the things the business has sold minus what they returned, what the customers returned, you get your net sales. Then gross profit. This is all the profit that the business made before subtracting the expenses. So it is not the exact profit, it is all the profit that they made. So it is net sales minus the cost of the sales. Then we have closing stock, what they call closing inventory. Stock that is available at the end of the trading period. That is a closing inventory. We also have a gross profits or gross loss. I've talked about gross profit, whereby it is the profit that is there before you subtract the operating expenses, supplementary incomes, any other incomes that you have except the gross profit is considered a supplementary income. For example, discount received, the rent income. We have operating expenses, which are divided into three categories. We have office and administrative, where we have salaries, rent, lighting, stationery, among others. Then we have selling and distribution expenses, where we have commission carried outward, bad debts. These ones are directly involved in expenses that incur with selling and distributing. Then we have miscellaneous expenses or other expenses, which may include interest on loan, interest on capital, depreciation, among others. So any other expense that does not fall under administrative and selling and distribution automatically falls under miscellaneous expenses. So in order to prepare an income statement, these formulas are very important. So the main purpose of preparing an income statement is to determine the gross profit or gross loss of the business. Sorry, the net profit or net loss of the business. And the formula is gross profit or gross income minus total operating expenses. Then gross income is the gross profit plus total supplementary incomes, as you can see there. Gross profit is net sales minus cost of sales. So as you're determining the net profit, if you look at our formula for net profit or net loss, you're supposed to first find the gross profit. So you will not be given the figure for gross profit, will not be given to you. However, they will give you the sales. Sometimes they will give you the net sales. So that makes net sales the first item that we enter in our income statement. Or if you don't, if they have not given you net sales and you're supposed to find it, net sales is the first thing that we enter in our income statement. So it all comes from the formula, whereby you're supposed to first look for gross profit, and to look for gross profit, you're supposed to first find the net sales. So meaning we're supposed to first look for the net sales in our income statement. So that makes sales first thing that you enter. Though most of the students normally cram that sales should be the first. No, you should be knowing where it comes from. So net sales, the formula is there. Cost of sales, opening inventory plus net purchases minus closing inventory. I explained what cost of sales means. Net purchases, here we're looking at the exact value of purchases that you have, the things that are available for sale. whereby if you get all the total purchases, you remove what you return to the suppliers in case it is there. And it is not a must that every business has returns inwards and returns outwards. And it's not a must that every business has wages and carries inwards. It varies. Some businesses are perfect that they sell goods that are very fine, and they also buy raw materials that are okay, so they don't have returns outwards, they don't have returns inwards. Then we also have cost of goods available for sale, goods that we have at the moment. Now this is the format. So you can see we have the sales. We're supposed to first look for net sales, because the first part of the income statement you look for a gross profit. Yes, you're supposed to first find the gross profit, and gross profit is net sales minus cost of sales. So we have to first look for net sales, which is sales minus. So less means minus, add means addition. So minus sales returns, we get our net sales. So these columns are also very important. So for this net sales, this is the calculation column where I'm pointing here, and this is the column where I write the final figure of the net sales. Then remember, we are looking for gross profit, so the next thing is less cost of sales, and cost of sales is opening stock plus net purchases. Net purchases, the figure is not given to you, so we're supposed to look for it the way you can see. So net purchases is total purchases minus returns outwards. So this is our format, as you can see it here. So let's go straight to our example. So we have an example here. Company Limited, that last December, by December 31st had the following: sales 8.6, purchases 3 million, inventory 600,000, that is opening inventory. So the inventory, the first date always qualifies to be the opening inventory. Discount received is there, carried on sales, returns outward, returns inwards, rent income, bad debts, which is also an expense, insurance, closing inventory is there, advertising, salaries and wages, and you have carried inward. So we have to prepare our income statement. Supposed to be income statement. Let's go straight to it. My formula is already here. So my format is already here. So this is how you're supposed to write your heading, the name of the business, the statement you're preparing for the year ended, or you can say for the period ended, then the date I've given you in the question. So I already drafted this. So remember, we are looking for gross profit first, and gross profit is net sales minus cost of sales. So meaning you're supposed to first look for the net sales. The net sales is sales, of which our sales is 8.6 million. Our sales is 8.6 million. So we're supposed to write in this column 8.6 million. Then our sales returns, which is returns inwards, is 800,000. 800,000. So in subtract the sales minus sales returns, so 8.6 minus 800, that is 7.8. Okay. 7.8 million. So 7.8 million. That is our net sales. So cost of sales equals to opening stock. Our opening stock, remember now we are looking for net purchases, because cost of sales equals to net purchases plus opening stock. So equal to opening stock plus net purchases minus closing stock. So our opening stock is 600,000. Write it in this column. 600,000. Our purchases, we're going to write them in this column. Purchases is 3 million. Purchases is 3 million. So in this column, 3 million. Carriage inwards if you have them. If you don't have them, it is not an error because as I've said, it is not a must for every business to have carriage inwards and wages. So if you don't have them, you just skip that and get your net purchases. So carriage inwards, see 200,000. Then we also have wages, 100,000. Mommy, tell those kids to go and shout from somewhere. He's shouting the whole day. Can't they play from somewhere else? So we have our wages. So when you add the purchases plus carriage inwards plus wages, we get what we call the total purchases. So that will be 3.3 million. 3.3 million. Then we are supposed to less purchases returns so that we get our net purchases. So purchases returns, or what they call returns outwards. Here we have 700,000. So we shall bring our 700,000 here. Normally in the books, I expect, or in the exam, I expect to be drawing a line. After you've added, you draw a line and you write the answer. After you've subtracted, you draw a line and then you write the answer either in the next column or where it is supposed to be, or in the column where the answer is supposed to be, depending on the format. So when you subtract 3.3 minus 700,000, our net purchases will be 2,600,000. Now again, full mathematics. You're also going to get outside. You have earphones, you use them. So goods available for sale. So after getting our net purchases, if we add net purchases plus opening stock, we get the value of goods available for sale. So which will be 2.6 plus 600,000 opening stock. We have 3.2 million. That is goods available for sale. And we are going to subtract our closing stock so that we can have our cost of sales. So when you subtract the closing stock or closing inventory, which is this 980,000, 980,000, shall now have our cost of sales. So 3.2 minus 980, plus 3.2 is a goods available for sale, which is opening stock plus net purchases. Now we are subtracting the closing stock so that we know how much did these goods that were sold cost. So that is 3.2 minus 980. 3.2 minus 980 equals 2.220. That is our cost of sales. So if you have to look and see, we have our net sales, we have our cost of sales. So we can now find our gross profit. The gross profit. So here we can't have stroke the gross profit. So 7.8 minus, that is 5. Our gross profit is 5,500,000. Then we check if you don't have supplementary incomes, it is fine. You just go straight to subtract the operating expenses. If you have the supplementary incomes, you identify them. So let's look at our information here. Supplementary incomes, we have discount received, which is 150,000. We also have rent income, which is 300,000. So discount received, rent income. So discount received is 150,000. 50,000. Rent income is 300,000. Those are the only incomes that we have. Let me try to increase the font size of these figures. That we can see them. So we have our total supplementary incomes. Total supplementary income, that is 450,000. So total supplementary incomes plus the gross profit gives you what they call the gross income. However, if you don't have incomes, you will not get the gross income. Just use your gross profit, subtract the operating expenses, and then you get your net profit. So minus 450, the gross profit, sorry, plus 5,580. That is the net profit, 5,580. Then plus our total supplementary income, which is 6,100,000. That. So what you are left with is we're now going to subtract S operating expenses operating expenses. So we begin identifying the operating expenses. Start from up here. We have carriage on sales. Carriage on sales. Which is when we have bad debts. Bad debts. Then we have insurance. Insurance. Then we have advertising. Advertising. We also have salaries and wages. So normally when they give you salaries and wages, it's different from wages. When they say wages alone, that's when it qualifies to be a direct expense. But when they say salaries and wages, it is an operating expense or an indirect expense, or they call overheads. Or also, if we say salaries, it also qualifies to be an overhead. Then I think that's all. So these are our expenses that we have. So right there in this column, carriage on sales is 600,000. Bad debts is 900,000. So carriage on sales, 100,000. Bad debts, 900,000. This is 900,000. Insurance, 120. Advertising is 100. Insurance 120. Advertising is 100,000. Then salaries and wages is 1 million. Salaries and wages is 1 million. Like that. So these are the only expenses that we have. These things like furniture, motor vehicle, those are not expenses, those are assets. Expenses are things that the business spends on either daily, weekly to run the business, not things it buys to use, like vehicles, computers, desks. Those are not expenses. Those are assets that are about to run the business. So, but here we look at things that the business spends on, these other expenses. These expenses on like daily to run the business activity. Like electricity, water, those are all expenses. So we have our total operating expenses, and let me give you a total here. $2.720,000, sorry, million. So our total operating expenses is 2.720,000. So remember the formula for net profit is gross profit or gross income minus total operating expenses. So we have our gross income, which is here. Then we have our total operating expenses, which is there. So I'm going to just change the color of this, but I'll change that later. So in subtract our gross income, which is 6,030,000, 6,030,000 minus our total operating expenses, which is 2,720,000, we get 3,310,000. So finally, we have our net profit for the business. So we have net profit. Is a net loss, you write there net loss. Is a net profit, write there net loss. How do you know that is a net loss? Of course, you'll see when the expenses are more than the gross income, you just know that is a net loss. So finally, our statement is done. So I can just change the color of this. Can also give it highlight. This is gross income. I can also give it another color. Gross profit can also have another color like that. But you can identify these key things. Cost of sales. Then we can also have our net sales here. So that this is our income statement. Let me just try to make it fit. So that you can see, though it is small, but you can try to, so you can see the title, you can see how it looks neat. So crossing the work is not accepted. If you make an error, don't make your work dirty. You just cross it out once and use a ruler, then you write the correct figure or correct item that you want to enter. Then even though you fail to get the correct net profits, any other correct entry that you make here or in any other financial statement is marked. Is marked any correct entry that you make. Even though you fail to get the net profit correct, fail to get the gross profit correct, but then there are entries you made, the expenses you put are the ones, the incomes you put are the ones, the purchases you entered are the ones, so you still get scores for those, and then the heading as well. So always make sure you hit. Thank you, and I wish you a blessed evening.